Hey guys, welcome back to the next episode of the podcast. Today we're going to be talking about borrowing capacity. Now, whether you're a first home buyer, investor, upgrader or business owner, people are always looking at ways to try and increase their borrowing capacity. So today we're going to look at a few of the key factors lenders look at when assessing borrowing capacity, and also provide some actionable tips that you can do before you even apply for a loan. So joining me today, we've got Dyl. Dyl, welcome.
Thanks for having me. A few good topics to cover here today, so looking forward to it.
Let's get straight into it. So what is borrowing capacity, I guess, is the key thing. Can you explain why it's not a fixed number?
Yeah, so I guess the simple way to look at borrowing capacity is income against outgoing. So it's a very basic method we can look at. And I guess why it's not a fixed figure is because each bank will have different policies, different servicing requirements, which will then impact how much you can borrow. So as a broker, we have 40 to 50 lenders on our panel, and each of those lenders will have a different amount you can borrow. So it's good to know what those differences are.
So can we maybe just touch a little bit on that? So we understand that different banks are going to have different capacities. Can you kind of give some examples as to how that works?
Yeah, so one thing is how they'll assess your income, for example, is probably a real common one. Also what their assessment rate buffer will be. So what the interest rate is plus the assessment rate. Now that can be a big variance between lenders. So some might have a 3% buffer, some might have 2%, and some even have 1%. So that can make a large difference with what you can borrow.
And policy as well, just on that note, I guess varies quite a lot.
Policies can be vary quite a lot through all the different banks. So the biggest one there is your income, obviously how they'll assess your income and what different requirements they might have for your income type.
Cool. So I guess we always say that maximising borrowing power is important, right? But why is that?
Yep. So for home borrowers or, existing homeowners, it's good to understand what your capacity is. So for someone out in the market looking to buy their first home or looking to upgrade their home, it's good to see where they sit and what their budget is. Making sure they're comfortable is the most important thing. So going out, telling them your budget's 1 million, for example, knowing that they're going to be around that range. If they need to go up a little bit, they can, but also understanding not to stretch themselves too far, but more so for investors as well. Our investor clients, they're looking to maximize their borrowing capacity every time they come to us to buy that next investment property. And the biggest reason we see is, property is a wealth creation tool. So if you're looking to maximize your borrowing capacity to purchase an investment property that's going to grow over time, you're going to generate wealth out of that as well. So understanding why certain banks will give you that money is really critical in that overall strategy.
Yeah, absolutely. So there's obviously some really key factors that determine one's borrowing capacity, right? So we'll go through a couple of these. Now, firstly, income, as goes without saying, is probably the most important factor. So how does that impact, depending whether you're a full-time employer, you're self-employed, or you're casual? How does this impact borrowing capacity?
Yeah, one of the biggest drivers for your borrowing capacity. So we touched on it a couple of times, but if you're a PAYG full-time employee, the banks will most of the time look to use 100% of your income. So that's the most common one. If you're casual, then once again, there's different policies for casual employment. Self-employed, again, some banks are really good at it, some aren't. What they need to see for your business and the tax returns or the financial statements will also impact what your borrowing capacity is. So there will be different shading requirements. So for example, do you earn bonuses? Do you earn commissions, overtime? A lot of the time the banks will apply a discount to that income. So they won't use 100% of it, anywhere from 20%, for example, discount on that income, which will therefore, I guess, in a way, reduce how much you can borrow. So, it's just because you're paid a bonus every year doesn't mean we can use 100% of that. So understanding what different banks have different bonus policies is really important for that scenario as well.
And you touched on the self-employed as well. Some banks may just want to see the most recent tax return. Others will want to see 2 years. So it's a common misconception as well.
Yeah, really common. So that's when we're talking to our self-employed clients is understanding what tax planning have you done. What does this current financial year look like? What do the past look like? Because that could dictate which lender we go to maximize your borrowing capacity.
100%. So before you simplified borrowing capacity to basically what comes in and what goes out. So we've touched on the income. Now, as far as debts are concerned, existing debts, what do lenders actually take into account?
Yep. So if we're talking about existing home loans, existing property loans, we'll look at the repayment on that. Now, the good thing is the banks will apply a buffer. So there is some protection there in terms of, if there's some rate movement. So, there is usually that assessment rate buffer on top of your existing home loans or your investment loans. So that's the first thing. So the repayment does have a buffer on top of that. I guess the other common ones are your credit cards, car loans. Is there any other facilities that we need to be aware of? So Afterpay, for example, or Zip Pay is some that always get missed. But the most common are your credit cards, car loans, and also novated leases.
Credit cards, that's a key one. Does having multiple credit cards, right? We're talking 3, 4, 5, even if you don't use them, or you pay them off every month, does that still have an impact on your borrowing capacity?
Has a big impact. So this is probably the most common one we see. Clients got 3 or 4 credit cards, couple at zero balances. The question we always get is, why do I need to include that? Well, the bank will always use the limit of that credit card in their assessment. So if you haven't used a credit card in 2 years and it's got a zero balance, then it might be time to potentially look at, maybe closing that out and not having it there, because it does impact your borrowing capacity significantly if you've got unused credit cards or multiple credit cards in your personal position.
Yeah, and I think that's a very common thing nowadays, especially with a lot of the frequent flyer point systems where people just open up credit cards for the sake of it, just to get these points, without really realizing how that impacts their borrowing capacity.
Correct.
So, definitely a good point. So we've got income, we've talked about debts, liabilities, loans, whatever the case is. The other aspect of all of our lives, as far as outgoings are concerned, is living expenses. How does that vary from lender to lender?
Yep, it will vary. Across the board, they can slightly have different minimum amounts. So the household expenditure model is what it's called, whether people have heard that or not. And each bank will have a slightly different amount of what that is. So we'll go through, our clients' detailed living expenses with them. We'll discuss them with them, and we'll see where that sits in terms of the bank's point of view. But things such as private school fees or travel, things that, that might have a large expense can impact your borrowing capacity as well. So it'll just be a discussion around, all right, where do you think you sit? Moving forward, will that be the case as well? Because the thing is, especially for people entering the market, you can make changes to your lifestyle when you are taking on a loan. So it's more so understanding your personal cash flows to make sure they are in line with the bank's expectations.
Yeah, and just on that, the bank's expectation or the household expenditure model, like you say, that's just an assessment based on the income that's being declared in the application?
So the applicant's income and also the household as a whole. So whether there's, 2 people in the household, if there's 2 parents and a child or 1 dependent, so that will also impact what their minimum amount or the household expenditure model amount will be.
Absolutely. So another key thing that's part of an assessment for borrowing capacity when banks look at your situation is your credit file and your credit score, right? Can you just talk a little bit about, I guess, first things first, what that entails, and does that impact borrowing capacity?
Yep. So all or majority of banks now will do credit reporting. So if you've got a credit card, you've got a car loan, an investment property loan, that is credit reported every month. So if there's missed repayments, then that will flag on your credit file. Yes, it will impact your lending options. So if you've got a clean credit score and a good credit file, then you're going to have more options, which therefore means more options for more borrowing capacity, because every lender is going to be a bit different. If you have some issues on your credit file, such as multiple inquiries, missed repayments, defaults, then that's going to limit the lenders that you can go to, which therefore there might be limited in terms of how much you can borrow based on that lender selection. So the key thing is understanding that when you apply for that credit card, apply for that home loan, it will show up on your credit file. So making sure you've got everything set up so you make those repayments on time is really critical.
Yeah. And I guess reducing your options obviously reduces how much you can borrow in that immediate respect, but going to these lenders where, they may accept your credit file due to some issues will usually warrant a higher rate in fees as well,
right.
which then further decreases your borrowing capacity?
Exactly right. So there is options out there, but it's going to limit it.
Yeah.
Limit it for you, yeah.
Absolutely. Now, you touched on before about when we were just discussing living expenses in terms of the family situation. How does that impact borrowing capacity?
Yeah, well, I guess dependents, more mouths to feed. So therefore, the way the bank will assess the household and how much you will spend each month will likely increase. So we actually spoke about this, I think, a couple of podcasts previous, is, we'll do some planning if you are planning a family. if that's in a couple of years' time and you want to maximize your borrowing capacity before you start that family. So, it's a hard one to plan for, but, being in contact with the client and understanding what that impact that could have on your capacity is also important.
Yeah. Now, lastly, one of the other, I guess, key factors is the type of property that you're buying or the purpose that you're buying for. So owner-occupied or investment, how does that impact things?
I guess the main difference between the two is if you're buying an investment property, we would like to hope there's going to be a rental return. So obviously you're bringing in some more income, which, as we discussed before, income against outgoings. It's going to assist with your borrowing capacity. The other thing to consider with investment properties, when you consult your accountant, there might be some tax deductions there or the benefit of negative gearing. This will also improve your borrowing capacity. So the main differences there is if you're borrowing for an investment, most of the time, not all the time, but most of the time, it's going to most likely improve your borrowing capacity or help you maximize it.
Absolutely. Okay, so we've kind of talked about what affects borrowing capacity. So I think it'll be really helpful to kind of touch on a few things or tips that might actually help to improve that. So what are some really quick wins in the short term someone can do to improve their borrowing capacity?
The real quick one, and the most common one, is understanding these unused credit cards. Facilities that you got on your credit file that you're not using. So if you've got credit cards, zero balances, probably look at closing them because they do have a big impact. The other one is, if you've got, potentially some HECS, there is some policies coming out around what impact that might have on your borrowing power. So Commonwealth Bank have just released something recently. So understand the implications of that. But yeah, just not having those credit cards sitting there and not using them is the real quick one.
And earn more money as well?
Earning more money is always nice. Yep. But look, it's funny you say that. We have this conversation with our customers all the time, depending on their profession, when they're starting out, is what do we map out your income growth to be? So in a year, 2 or 3, whilst it's not quick, but it's also good to understand what that would look like. Yep. So yes, earning more income, maybe go to your manager or go to your boss and ask for that pay rise because it can make a difference.
I think we know what we'll be doing after we get out of this interview.
We'll head out there straight away.
Yeah.
Ask the question.
And I guess in terms of planning, it's a word that you use very often, right? And that's because that's our philosophy. So how far in advance should people be planning?
As early as possible. Get in touch with us as early as possible. If you want to understand what your capacity is, if you're just starting to think about buying that first home or you're starting to think about buying that investment property, get in touch with us. We can take you through what your options would be. If capacity looks good, great, we can put together a plan for you. But if we need to make some changes, such as reducing credit cards, paying out car loans, whatever it might be, rather start that now, get you set up, and then you can start that property process as well.
Yeah, and on that note, specifically for our self-employed clients and borrowers, what's really relevant and important for them when it comes to planning?
Yeah, so tax planning is critical. Having your financial statements and your tax returns in order is one of the biggest factors that's going to either hold you back or allow you to do that next purchase. So we'll talk or we'll be advising you in line with your accountant's recommendations as well. But the best thing is make that introduction to the accountant, or we can reach out to them and we can have a discussion about what your plans are for the business, but also how things are looking from an income point of view for the current financial year, for previous, but also for moving forward. So around tax time, having your financial statements in order is really critical because that's a massive driver of your borrowing capacity.
Absolutely. And I guess, again, different lenders on that front have different timelines as to when they need updated tax returns. But if you're prepared, and if we're talking about options and maximizing, I guess having it ready and good to go gives you a wider range.
Having the options is critical.
Yeah.
Having more lenders on the table means potentially there's more to borrow there, or still get you the best product and the best rate. So it's good to be prepared for that.
Yeah. Talking about quick wins, consolidating debt. So we talk about these unused credit cards or the personal loans. How does consolidating debt prior to applying for a home loan or investment loan work? And how does that boost capacity?
Yep. So whether if the client might have the cash to pay out those facilities, if they do, great. We'll consider that as part of their overall strategy. If it's a case of maybe they've got a home, they've got some equity, their credit cards at 11%, 20%, whatever it might be, the car loan might be a little bit higher. We might look at doing consolidation, so utilising the equity in their current home to access that to pay out the credit cards. Now, the key component there is we don't want that paid over a 30-year term, it's making sure that we pay that portion off still over the remaining term of that car loan, if we're using that example. But that can have a significant boost if you've got multiple of these credit cards or car loans, consolidating them into one, at a much lower rate. Yeah, as I said, can definitely improve your overall position as well. So something that we do consider for clients with more of those facilities.
Absolutely. Affordability is becoming harder, especially for your first home buyers, just the way the property markets are, not just in Perth, but across the country. How does applying with a co-borrower, and that could be anyone, it could be a brother, it could be a sister, a partner, how does applying with a co-borrower help improve one's capacity?
So it comes back to that income against outgoings. We're adding a second income. So, it sort of de-risks it from the bank's point of view as well. There's two incomes coming in to pay that loan. So yeah, you've touched on it. It's something that we are seeing a lot more of now. Not just partners buying, it's friends, it's brothers and sisters, and it's becoming more and more popular. So understanding what that looks like, understanding the two income types for those two applicants potentially is becoming more and more common, and essentially bringing that second income in can help with the borrowing capacity.
And just on that, there are ways to structure the loans so that they're kind of separate.
Yep.
So even if you're, wanting to buy with a friend, for example, you can kind of keep things separate and clean. It's something that we're seeing a little bit of.
Been very common over the last little bit. And there is, lenders out there that will allow you to do that. And something to consider, because if you're buying with a friend, whilst your plans are aligned now, in 5 years' time, they might not be. So one of the most common ones we look at is, can we just allow your borrowing portion to be only on your name and their facilities not in your name, so it doesn't restrict you moving forward.
Yeah.
We can take clients through those options if that's part of their plans.
Yeah, absolutely. And just on that, the ownership structure. So that's one way of looking at it. There's other entities or ownership structures. How does that improve borrowing capacity?
Yeah, this is a big one for our investor clients. So, you might be buying a property in your personal name, or if we're looking at different entities, a company or a trust structure. So what we're seeing is, for a lot of our investor clients, they get advice from their accountant about maybe the best structures to buy it in a trust or a company. The biggest factor here is, based on how that's set up, is we can isolate the debt in that entity. So moving forward, if that client or that customer is looking to borrow for another purchase, as long as that entity is profitable and can cover its liabilities, we can look to isolate that debt and then borrow again. So very much case by case, but one that we will discuss with our clients, with their advisors as well.
Yeah, because it's not just about borrowing capacity. There's lots of other things, I guess, we've got to factor in in terms of asset protection and stuff like that,
Correct.
which we've spoken about before.
Yep. Correct, yep.
Right, so we've talked about, I guess, a few tips. Now, we see these mistakes quite often. What's probably the most common mistake that you see on a daily basis when it comes to borrowing capacity? And I have a feeling I know what your answer is going to be, but yeah.
Yeah, we've touched on credit cards, so we've already spoken about that. It's a massive one. The other one is car loans as well. So, an applicant might have gone out and purchased a car and got car finance without understanding what impact that's going to have on their borrowing capacity, and it can be significant. What we're seeing more and more of as well is novated leases. So that is a deduction off your income. It shows up in your payslip. This also impacts your borrowing capacity. So if you are thinking about buying a car and taking out finance, or looking to take out a novated lease, chat with us first, because we can take you through what implications that will have on your capacity. Because if you're looking to a house purchase and a car purchase at the same time, maybe we get prepared for that and map it out before you make a call on that car.
Yeah, absolutely. Having multiple loans and credit cards, can that reduce your credit score? We talked about credit score before. And does that, again, in turn, reduce your borrowing capacity?
It can. If you're doing multiple a month, and I'm talking 5 to 10 a month, then yes, the more inquiries you've got, the more questions they're going to ask, and it might restrict your credit score and limit your credit score or limit your options. So we would never go out and apply for 5 credit cards in 1 month, or 5 home loans in 1 month, because it can impact it. So usually we'll discuss with our clients about what the implications are when we apply. But yeah, credit score is really important at the moment. So understanding where yours sits, and the implications of taking out these facilities, if it's going to impact it or not. So we'll run through that with all our clients.
Yeah. And again, just a quick one. I know we briefly touched on it before, but especially for our younger clients, first home buyers, debts like HEX. How often is that forgotten that that's actually a debt?
Yeah, it is one that can be forgotten because, there's no actual, facility that shows up on your credit file, for example. So for a lot of our clients or first home buyers or existing clients that have that set up, it will just be a discussion about what's the balance of that HEX repayment and HEX balance, and then, talking through what does that mean and how does that impact your borrowing capacity. If someone's got it's getting towards paying it out, then we might have that discussion around maybe that the benefit is there to pay it out and improve your capacity. If there's still a bit of a chunk to be paid off, then we might consider some new policies that have been introduced to improve your borrowing capacity with HEX. So there's more coming in that space, but it's something that we definitely discuss with our clients about the implications of, and making sure that they're aware that yes, HEX does actually impact your capacity.
Yeah, and probably really relevant as well, just with the election that's gone past. There's some proposed changes to HEX. Labor, winning the election, have said that they might wipe out 20% of people's HEX debts. So if that does come to fruition, I think it's really important for people that have debts to reach out, just to understand, right, at this point, does this have an impact on my capacity, or can I potentially pay out my HEX debt? So,
yeah, definitely worth considering. So yeah, watch this space with there. So more to come, I think.
Very good. Now we're just about out of time, but before we go, what's your one key piece of advice for someone who's looking to improve their borrowing capacity?
We always touch on it, but plan. So get in touch with your broker. Let them understand what your plans are and what you're looking to do, because as we've said, there's quite a few lenders out there, different policies. And how your income is generated is gonna impact how much you can borrow. So sit down with your broker, understand an overall strategy, and make sure the lender selection is the right one for you.
Beautiful. That's all we have time for today. Dill, thanks for joining us and sharing those great tips. And we look forward to seeing you next time.